and welcome to Morningstar. I'm Emma Wall and I'm joined today by Stuart Mitchell, manager of the SWMC European Fund, to give his 3 stock picks. Hi Stuart.
Morning.
So what's the first company you'd like to highlight today?
I want to talk about Intesa Sanpaolo, Italy's largest bank. It's a fabulous franchise, largest market share, great access to cheap deposit funding, a very highly developed asset management business where basically as deposits roll off at low rates, customers are then being encouraged to invest in mutual funds or in specialist bond portfolios to get slightly higher yields. It's a wonderful, wonderful business.
But it's been hit quite hard recently, hasn't it, with all the sort of negative sentiment around European financial stocks?
It has, and in Italy worse than any others. There's a view that the stock of NPLs is kind of too large at this stage of the cycle, and is going to need more urgent action to start to reduce, to get control of it. Intesa, of course, being the largest is and the best quality, for them it's not really an issue, but for some of the smaller banks, regional banks, it's quite a significant problem. But again, there are all sorts of interesting new rules being put in place to help that whole process of sorting out the bad debts. And there's another, we hope, plan which is going to be announced in the next few days, where basically all the largest banks will pull together their bad debts, and then it'll be managed as one large kind of entity. But looking at the micro, non-performing loans are falling in Italy at the moment. The economy is beginning to recover very nicely. And remember that non-performing loans are extremely highly leveraged to the growth rate in the economy. And
which is kicking in.
Which is kicking in. So very roughly, we think that Intesa Sanpaolo is comparable with a company like Wells Fargo in the US. We think it should be trading near 1.6, 1.7 times book. At the moment, it trades 1 times book. And we think as confidence comes back to the financials in general in the Italian economy, that the share price should rise to reflect that.
And what's the second stock today? And
the second stock is Orange. It's an old friend of ours. We think telecoms is a very compelling industry within Europe, and it's all about a subtle sort of shift in emphasis from the politicians and the regulators. In the past, it was all about breaking up the monopolies, supporting the consumer, giving choice. And now there's a realization that the regulators have to encourage investment. And of course, to encourage investment, you've got to give a little more slack to the operators themselves, allow them to create a bit more profit. So a number of very important things have happened. Most crucially is the whole consolidation in the mobile sector. And Orange is right in the focus at the moment because it looks as if they're about to buy Bouygues Telecom, which will take out the 4th player, leaving 3 players. And where that's happened before, we've seen pricing has begun to increase quite significantly.
And one of the things that's happening in the telecoms industry across Europe is that they're moving into this sort of quad play format, offering Absolutely. Television, landlines, internet, and indeed mobiles. Are Orange looking at that sort of?
They are. I mean, you're absolutely right. That's a kind of the second crucial thing, convergence. And it's quite difficult to understand how it's been so successful, because at the end of the day, most converged products, they aren't really converged. You have one bill, but they don't kind of relate or link to each other except in the most crudest way. And it seems what's happening is that because you have the package is so complex and there's so many different parts to it, consumers basically can't compare to other packages, and so it reduces churn. And there's the ease of having one bill. But it's not obvious yet that there's really such a thing as a properly converged product.
But good for the share price.
Yeah.
And what's the third stock today?
And a third stock is Orpea, which is a retirement home business in France. We all think it's a horrible industry based in the UK because it's not regulated, and all these terrifying stories of all people who've been horribly abused in homes. But in Europe it's very different. You have to get a license to operate a retirement home. Pricing is fixed. So there's some kind of control from above. There's a quality control. And of course, if you're the largest, then you have a real advantage over everybody else. You understand the whole process of getting the licenses. You can be much more clever on cost. You can transfer employees around different homes. So Orpea have made the dash to become the largest. And of course, as we all know, the world is getting older and older and older, and the number of post 85-year-olds, 65-year-olds is rising very, very fast. And so that should mean that the industry itself is growing at 3 or 4 or 5% organically anyway in the next few years.
Industries which are regulated often behave like utilities, which is good for investors because it means that they have sort of visibility over the future earnings of a company. And is that the case with this stock?
It is. It's a great observation. I mean, it's always a kind of tricky one because when they get obviously overly regulated and they become political footballs, and there's a risk of things being changed retrospectively, and as you've seen in the gas industry in the UK. But I think in healthcare, it's the regulation is relatively light touch, that is just enough to keep the competition out, but it's not too much, I think, for it to become something kind of politicised and risk of further severe regulation being introduced.
Stuart, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.